Imagine running a business, right? And the overall profit pie lie, the actual money you make at the end of the day, actually shrinks. Fewer dollars make it to the bottom line.
Right, which is usually panic mode for a company.
Exactly. But somehow, despite that, your individual investors walk away richer than they were before, like mathematically richer.
It sounds like fake math, honestly.
It really does. But today, we're looking at a Q1 earnings report that proves corporate math just, well, it does not always work like normal, everyday math. And, getting to the bottom of this math for you actually felt like a bit of a mission today.
Oh, yeah. Did you run into the firewall?
I did. I was pulling up some financial data on MarketBeat for you, getting ready to, comb through the sources for this deep dive. And before I could even look at a single number, this prompt pops up. Performing security verification.
Ah, the classic Cloudflare check.
Yeah. I literally had to sit there while Cloudflare ran its checks to prove I was an actual human being and not like some malicious bot trying to scrape their servers.
It is the modern internet hurdle, right? But, I mean, it serves as a pretty good reminder of the digital barriers that are constructed around high-value information. The financial sector is, well, they're incredibly guarded about data flow.
Oh, for sure. It felt like dealing with a digital bouncer at the door of a club.
Yeah.
But our mission today is to bypass those bouncers, cut through the incredibly dense financial jargon, and basically uncover the real story hiding inside a massive corporate earnings document.
And we've got a great one today.
We really do. Specifically, we are diving into the Q1 2026 results from Boyd Gaming Corporation, and we're sourcing our data directly from an official court financial document.
Right. And an earnings report of this magnitude, it really offers a fascinating window into how a massive enterprise navigates, well, real-world friction. Because this data is not just a ledger of past performance, it's really a live map of corporate strategy.
Yeah, and for anyone listening who might hear the word gaming and immediately picture like a single neon-lit casino on the Vegas Strip, Boyd Gaming operates on an entirely different scale.
Oh, totally. It's not just one building.
Not at all. Founded back in 1975, this is a massively geographically diversified operator. We're talking about 27 gaming entertainment properties spread out across 11 different states.
Right. Plus, they manage a tribal casino in Northern California, and they possess this rapidly growing online footprint, too.
Exactly.
Their sheer scale and that geographical spread, those are the variables that make this specific financial report so illuminating.
Yeah, so even if you never step foot on a casino floor or, you never pull a slot lever in your life, the mechanics inside this report matter to you. Because what we are analyzing here is basically a masterclass in how massive corporations utilize diversification and some clever financial engineering to survive localized disruptions.
Right, whether that disruption is a softening economy in one specific city or physical construction delays.
Or literally just bad weather keeping people indoors.
Exactly. We are looking at a blueprint for corporate resilience here. The numbers basically reveal how a company builds shock absorbers right into its business model.
Okay, let's unpack this. Because right at the top of these Q1 numbers, there is a massive contradiction that we really need to resolve. I am looking at the top-line numbers for Q1 2026, and the overall profit dropped. Yet the value of an individual share went up.
Yeah, the data presents an apparent paradox right out of the gate.
It's wild. Let me lay out the specific details from the report so we have the baseline. In Q1 2026, Boyd's total revenues actually experienced a slight bump. They hit $997.4 million, which is up from $991.6 million in the same quarter last year.
So more money is technically coming through the doors.
Right, but their total net income, which is the actual profit they take home after all the expenses are paid, that fell. It dropped from $111.4 million last year down to $105.5 million this year.
Right, so the profit margin tightened, leaving them with, fewer total dollars at the end of the quarter.
Yeah. And before we get to the whole per-share mystery, there is another metric here that decreased. Total adjusted EBITDA. It dropped to $317.4 million from $337.5 million. But I want to pause on that acronym for a second.
Sure, it's a mouthful.
It is. Because financial reports love to throw around EBITDA, right? Earnings before interest, taxes, depreciation, and amortization. We see that everywhere. But this report specifically uses EBITDA with an R at the end.
Ah, yes. The all-important R.
What exactly is that?
So the R stands for rent, or sometimes restructuring costs. And it is a crucial distinction in industries that are heavily reliant on physical real estate. Think casinos, airlines, retail chains, things like that.
Okay, because they don't always own the buildings.
Exactly. Many operators do not own the land or the massive buildings their businesses occupy. They lease them, often from these huge real estate investment trusts. So rent is a massive structural fixed cost.
That makes sense.
Right. By using EBITDA and pulling rent out of the equation, analysts can basically evaluate the actual operational performance of the casino floor itself. It creates an apples-to-apples comparison across different properties, totally regardless of who owns the underlying dirt.
Got it. That makes perfect sense. So looking at the operational cash flow through the lens of EBITDA, the number is down. The total net income is down. The overall profit pie undeniably got smaller in Q1 2026.
Unquestionably.
So here is where I am genuinely confused. Despite the total net income dropping down to $105.5 million, the basic net income per common share actually went from $1.31 last year to $1.37 this year. I mean, the math feels broken. How does the overall pile of money get smaller, but the piece assigned to a single share gets bigger?
What you are observing the mechanical power of an aggressive open market share repurchase program.
A buyback.
Exactly. Corporate strategy is rarely limited to just, generating more revenue. It heavily relies on financial engineering to manufacture shareholder value from the existing cash flow, and the report details that Boyd bought back $155 million in common stock during the first quarter alone.
Okay, let me see if I am visualizing this mechanism correctly for our listeners. Is this scenario essentially like ordering a pizza for a group of friends?
I like where this is going.
Right, so if the pizza arrives and it is slightly smaller than the one we ordered last week, which represents a drop in total net income, my personal slice should logically be smaller.
Naturally, yeah.
Unless, before the pizza even hits the table, I pay 3 of my friends to leave the room. The pizza is smaller, but because there are fewer people dividing it, my personal slice is actually thicker.
You are capturing the mechanics flawlessly. Boyd Gaming essentially paid millions of dollars for shares to just leave the table.
Oh, wow.
Yeah, when a company uses its cash to buy its own shares on the open market, it retires them. Those shares basically cease to exist in the total count. So looking at the data, Boyd's weighted average basic shares outstanding plummeted from roughly 85.1 million in 2025 down to 76.7 million in 2026.
That's massive. They erased almost 10 million shares in the denominator of the equation.
And that alters the fundamental math of the entire company. Your total net income is indeed smaller at 105.5 million. But because you are dividing that profit among roughly 8.4 million fewer shares, the remaining shareholders inherently own a larger percentage of the company.
Hence the earnings per share jumping up to $1.37.
Exactly. It is a deliberate lever management can pull to reward loyal shareholders and signal confidence, even when the broader operating environment presents these kinds of headwinds.
See, but the concept of headwinds brings up a really critical point about causality here. Because financial engineering is fascinating, sure, but you cannot buy back $155 million in stock with theoretical money.
No, you definitely cannot. You need hard cash.
Right. You need actual cash flow. All the share repurchases in the world will not save a company if they are not effectively running their physical businesses. The money funding this financial engineering has to be generated on the ground.
Absolutely. And the transition from the spreadsheet math to the physical reality of their casino operations reveals a really fragmented landscape. Across those 27 properties, performance was heavily dictated by geography.
So let's examine that geographic map, because the report makes it super clear that Boyd's Midwest and South segment essentially carried the weight of the entire company this quarter, while the Las Vegas properties actually struggled.
The contrast in those regional numbers provides the ultimate proof of their geographic hedge strategy in action.
Yeah, the Midwest and South segment saw both revenue and adjusted EBITDA growth. The report attributes this to an increase in play from core and retail customers. But there is a very telling detail included in there. They cite a favorable comparison to last year's severe winter weather.
Ah, the weather variable.
Yeah. Last year, massive winter storms literally kept customers trapped in their homes. This year, the weather cleared up, the doors stayed open, and the numbers rebounded beautifully.
It serves as a really stark reminder of how vulnerable regional entertainment venues are to elements completely outside of management's control, like a severe blizzard.
Right. Meanwhile, the Las Vegas locals segment, which are the casinos that cater to the people who actually live and work in Vegas, took a hit. The report points to continued softness in destination business impacting those properties.
Right, fewer people flying in.
Plus, they suffered from physical construction disruptions due to ongoing renovations at their Suncoast property. So the Midwest is thriving due to clear skies, while Vegas is hurting due to soft travel and, construction dust.
A tale of two markets.
Exactly. And then, nestled right in the data, there is this highly specific detail regarding the downtown Las Vegas segment.
The downtown dynamic presents an entirely different demographic variable, for sure.
Here's where it gets really interesting. The report notes that downtown Las Vegas maintained its financial stability specifically thanks to, and this is a direct quote from the source play, from Hawaiian guests.
Hawaiian guests, just a very specific call-out.
Right. This specific demographic influx basically offset the reduced destination business from other regions. But analyzing this really makes me wonder about the structural integrity of your strategy.
How so?
Well, if a localized issue, like a Midwest snowstorm last year, or a sudden dip in Hawaiian tourism this year, can swing millions of dollars in revenue, is a massive geographic spread actually a protective shield? Or is it just like a heavier suit of armor that exposes the company to a far greater number of random, uncontrollable risks?
That's a great question. If we connect this to the bigger picture, the strategy functions similarly to a broad index fund.
Okay, like in investing.
Exactly. If an investor puts all their capital into a single technology stock and that sector crashes, the portfolio is decimated. But if the capital is spread across technology, healthcare, agriculture, and energy, a downturn in one sector is often mitigated by stability or growth in the others. Boyd's strategy creates a mutual fund of real estate and regional entertainment.
Ah, I see. So they are actively acquiring uncorrelated risks.
Precisely. The statistical probability of all those distinct, geographically isolated risks occurring simultaneously is incredibly low. The Midwest rebounded from winter storms at the exact moment the Vegas destination traffic softened. The Hawaiian demographic held the line downtown while the Suncoast property was under construction.
It's all balanced.
They have engineered a system where they are not relying on a single demographic, a single city's economy, or even a single weather pattern.
The strength of one region covers the temporary weakness of another. That makes a lot of sense. And looking at the source, they're diversifying beyond just physical ownership, too. The managed and other segment demonstrated growth in revenue and adjusted EBITDA, driven primarily by increased management fees from the Sky River Casino in Northern California.
Now that property introduces an entirely different operational model because it is a tribal casino. Boyd does not own the physical asset, they simply manage the operations for the tribe.
Which is brilliant, because they are generating a growing stream of revenue and pure profit from a property without having to deploy the hundreds of millions of dollars required to build it.
Exactly, the capital expenditure is zero.
And that capital efficiency is vital, because when you look at Boyd's balance sheet, you realize why they need every ounce of efficiency they can squeeze out of their operations. The ratio of their debt to their future development commitments is just staggering.
The scale of capital deployment required to compete in the modern gaming industry demands a very specific financial posture.
Yeah, posture is a good word for it. As of March 31st, 2026, the quarter document states Boyd has $372.7 million in cash on hand. However, they are carrying a total debt load of $2.3 billion.
That is a mountain of debt.
A mountain. And despite carrying that $2.3 billion obligation, their capital expenditure is incredibly aggressive. They just opened the new Cadence Crossing Casino to bolster the Las Vegas locals segment. They are actively funding a massive $750 million resort development in Virginia. On top of that, they just received regulatory approval to expand their Paradise property in Illinois, with construction slated to begin next year.
It really is a capital-intensive growth pipeline playing out simultaneously across multiple states.
And the spending extends way beyond physical buildings. We already discussed the $155 million in stock buybacks during Q1. In addition to that, they increased their quarterly dividend payout from 18 cents to 20 cents per share.
Returning capital directly.
Right. Between the buybacks and the dividends, they returned nearly $170 million to shareholders in just 3 months. And if that wasn't enough capital flying out the door, the source notes that the board authorized an additional $500 million for share repurchases in April, literally right after this quarter ended.
The liquidity is just being deployed in multiple directions, to creditors, to physical expansion, and directly to shareholders.
So what does this all mean? Because I have to push back on the sustainability of this strategy. You have a company holding $372 million in cash, staring down $2.3 billion in debt. How does a management team with that specific ratio confidently break ground on a $750 million resort in Virginia, while simultaneously burning hundreds of millions of dollars on stock buybacks and dividends.
It looks a bit risky from the outside, doesn't it?
It looks like they're walking a terrifying financial tightrope. One misstep and the debt crushes them.
Right, but this raises an important question about how leverage functions in a corporate context, specifically within industries possessing specific margin profiles. To understand how they manage that $2.3 billion debt load without panicking, we have to look closely at a concept called operating leverage,
Okay, operating leverage.
which CEO Keith Smith actually alluded to when he highlighted their successful focus on operating efficiencies. The crucial data point hiding in this report, the absolute linchpin that holds this entire financial structure together, is that their property-level margins exceeded 39%.
A 39% margin. Let's break down the mechanics of that, because that sounds high.
It is very high.
Uh-huh.
To conceptualize a 39% margin, compare a casino to, say, a traditional grocery store. A grocery store operates on variable costs. For every apple they sell for $1, they might have had to buy that apple from a farmer for 90 cents.
Right, so their margin is incredibly thin, requiring massive volume just to break even.
Exactly. A physical casino, on the other hand, operates primarily on fixed costs.
Meaning they construct the building, they buy the slot machine once, and they pay a flat rate for the electricity and the basic floor staff.
You've got it. Once those fixed costs are covered for the month, the cost of the next customer walking through the door and pulling the slot lever is effectively zero.
Oh, wow.
Right. Almost every single dollar of revenue generated past that break-even point flows straight to the bottom line as pure operating profit. In a capital-intensive industry, maintaining margins above 39% means the business generates an immense, highly predictable fire hose of cash flow.
Okay, so the strategy does not rely on the $372 million sitting in the bank account today. It relies on the absolute certainty of the cash flow that will be generated tomorrow, next week, and next month by those high-margin properties.
Exactly. That consistent cash engine is what allows them to confidently service the interest on $2.3 billion in debt. It funds the massive multi-year developments like the $750 million Virginia resort, and it still leaves enough excess liquidity to execute $500 million share repurchase authorizations to keep Wall Street satisfied.
That's incredible.
They are not balancing on a tightrope. They have built a financial engine that is heavily leveraged, sure, but finely tuned to handle the immense weight.
That structural reality completely reframes the entire balance sheet. The debt is not a sign of distress. It is a calculated tool fueled by their confidence in maintaining that 39% operating efficiency.
The debt is basically the leverage utilized to amplify the returns of that highly efficient cash engine.
To bring this all together for you listening, diving into a dense corporate document like Boyd Gaming's Q1 2026 earnings really reveals that headline numbers rarely tell the complete story. An earnings report is never just about top-line revenue. We've unpacked the mechanics of the EPS illusion, how retiring millions of shares through open market buybacks can artificially inflate the per-share value for investors, mathematically increasing their wealth even when total net income drops.
Yep. And we have also analyzed the structural architecture of the geographic hedge, relying on the Midwest to cover for softness in Las Vegas, or utilizing Hawaiian tourists to offset a dip in destination travelers. It creates a very resilient portfolio.
Okay.
It acts as an index fund of entertainment that absorbs localized shocks.
And crucially, we explored how achieving massive 39% operating margins creates the immense cash flow necessary to carry billions in debt, fund $750 million physical resorts, and reward shareholders simultaneously. It is a complex, high-stakes system of capital allocation. And I think the most valuable takeaway here is that you can apply this exact same analytical framework looking past the top-line revenue, questioning the share count, and examining the operating margins to literally any massive corporation in any industry you are evaluating.
Definitely. The underlying mechanics of corporate finance remain pretty consistent across the board. But before we conclude, there is one final data point buried in this report that points toward a really fascinating structural shift. And I want to leave you with this thought to sort of explore on your own.
Let's hear it.
Well, we spent the majority of this analysis dissecting the physical reality of the business, right? Midwest blizzards, construction disruptions at the Suncoast property, Hawaiian flight patterns, and that $750 million brick-and-mortar resort in Virginia.
Right, all very physical things.
But the court document also isolates their online segment. This includes Boyd Interactive's B2B and B2C operations, as well as online reimbursements. Now, the operating cost for online reimbursements alone exceeded $135 million this quarter, which indicates a massive volume of revenue flowing through that digital ecosystem.
135 million in just reimbursements. That is a staggering amount of capital flowing through a sector with zero physical footprints.
Exactly. Which leads to a really provocative question regarding the future of capital allocation. Physical properties demand hundreds of millions of dollars just to construct. They require massive ongoing maintenance, and as we saw in the data, their revenue generation is entirely subject to localized weather patterns and geographical limits.
Which online gaming doesn't care about at all.
Right. The frictionless online gaming sector continues to expand exponentially without any of those physical constraints. So as that digital ecosystem scales, will these massive billion-dollar brick-and-mortar casinos eventually become nothing more than incredibly expensive, high-maintenance marketing showrooms designed solely to funnel users toward the real profit engine, the digital platform sitting quietly in your pocket?
Wow. We started this deep dive fighting off a digital bot just to access the financial data. And the numbers suggest the digital world might eventually come for the physical casinos themselves. That is a lot to chew on. Until next time, keep digging into the data behind the headlines.